For years, the Iraqi Dinar story has lived in a strange place, not fully dismissed, not fully confirmed, always about to happen, yet never quite arriving. And that's exactly why today's discussion matters, not because of one headline, not because of one rumor, but because of what this moment tells us about how currency narratives form, why they persist, and where reality actually sits beneath the noise. Here's the part most people miss. When a claim surfaces involving a major global bank, especially one with the scale and regulatory exposure of JPMorgan Chase, it instantly changes how people feel about the story, even before it changes what we actually know. That emotional shift alone is powerful. It's also dangerous if it's not understood properly. So instead of asking, is this real? The better question is, why do these stories keep resurfacing now? And what would have to be true in the real financial system for any of this to matter? Now zoom out for a second. The Iraqi dinar has been under some form of managed constraint for decades. Wars, sanctions, political fragmentation, oil dependency, capital controls. This isn't a normal emerging market currency story. It's a post-conflict monetary system still trying to stabilize credibility, not just value. That distinction matters. Because currencies don't revalue in isolation. They reprice when systems change: banking access, settlement mechanisms, trade flows, reserve management, and institutional trust. This is where most dinar conversations go wrong. People fixate on the exchange rate and ignore the plumbing underneath it. So when you hear claims about a bank preparing or a green light, what that usually signals, if anything at all, is not a secret overnight revaluation, but operational readiness, compliance readiness, systems compatibility, scenario planning. Large banks don't speculate on currencies the way retail traders do. They prepare for contingencies long before anything becomes public. That's not confirmation, but it's not meaningless either. Here's where it starts to matter for markets. Iraq, quietly and without much fanfare, has been under pressure from international institutions to modernize its financial infrastructure. Anti-money laundering compliance, digital payment rails, reduced dollar leakage, stronger central bank controls. These aren't dinar holder talking points. These are IMF level issues. And when you see Iraq tightening currency auctions, adjusting dollar access, or experimenting with settlement reforms, those are currency relevant actions. Not revaluations, but prerequisites for credibility. Now contrast that with what most people think. Most people imagine a revaluation as a switch being flipped. In reality, it's more like pressure slowly building inside a system until policymakers allow repricing because they can manage the consequences. If Iraq were to allow its currency to strengthen meaningfully, it would need a stable fiscal position, predictable oil revenue management, functional banking intermediation, confidence that capital flight wouldn't explode overnight. Those are not small boxes to check. This is why timelines matter, but not in the way people expect. When someone says, this is happening soon, that usually reflects anticipation, not authorization. Financial institutions anticipate all the time, governments rarely authorize. But there's another layer to this. The dinar conversation tends to resurface during periods of global monetary transition. When the dollar tightens, when liquidity shifts, when emerging markets are forced to clean up their balance sheets. And right now, globally, we are in exactly that kind of phase. Liquidity is more selective, capital is more cautious. Currencies are being judged harder than they were 5 years ago. In that environment, countries like Iraq are incentivized to project stability, even if full normalization is still far off. That's the context most people never hear. So when claims circulate about banks preparing, it's often because systems are being stress tested, not because a jackpot event is imminent, but because regulators demand readiness under multiple scenarios. That doesn't make the dinar story false. It makes it far more complex than it's usually presented. And complexity is where serious analysis lives. Now think about incentives. Who benefits from Iraq slowly strengthening its currency credibility? Domestic importers, government balance sheets, long-term foreign investors. Who loses? Speculators who need abrupt moves, black market intermediaries. Systems built on arbitrage rather than productivity. This is why any real currency evolution would likely be gradual, managed, and boring by design. And yet here's the tension. Markets hate boredom and narratives thrive on drama. That's why these moments resurface again and again. So the right posture for anyone watching this space is not excitement or dismissal. It's calibration. Watch policy, not promises. Watch banking reforms, not leaks. Watch settlement rules, not rate fantasies. Because if the dinar ever truly changes its role, you won't hear it first from a rumor. You'll see it first in constraints being lifted. And when that happens, it won't feel explosive. It will feel procedural. That's usually how real financial shifts begin. But we're not done yet, because there's a second dimension most people ignore entirely. What happens after a currency gains credibility, not just value. And that's where the story gets genuinely interesting. Now let's deal with a phrase that gets thrown around constantly, but almost never explained properly. Global tradability. On the surface, it sounds simple. A currency becomes tradable, accessible, liquid. But in the real financial system, tradability is not a switch, it's a permission structure. For a currency to trade freely on global platforms, several things have to be true at the same time. International banks must be willing to clear it. Correspondent banking relationships must be active. Settlement risk must be manageable. And regulators must be confident that the currency isn't being used to bypass controls. This is why many currencies technically exist, but functionally don't participate in global markets. The Iraqi dinar sits in that gray zone. It exists. It's used domestically, but internationally, it's constrained not because of conspiracy, but because of risk management. Here's where it gets interesting. When people hear that a bank is preparing for changes related to a currency, what that usually reflects is internal scenario planning. Banks run these exercises constantly. What happens if capital controls loosen? What happens if settlement rules change? What happens if a central bank adjusts its operating framework? That kind of preparation doesn't mean the event is guaranteed. It means the institution doesn't want to be caught flat-footed if policy shifts. And that distinction matters more than most people realize. Because the real story here isn't about a sudden surge in value. It's about whether Iraq is slowly positioning itself to re-enter normal financial circulation. That's a much longer road, but also a more realistic one. Now zoom out again. Iraq's economy is still overwhelmingly tied to oil. That creates a very specific monetary dilemma. When oil prices are strong, foreign currency inflows rise. When oil weakens, pressure returns immediately. A strong currency sounds attractive, but it can actually hurt competitiveness if it's not supported by diversification. This is why central banks in resource-heavy economies tend to move cautiously. Too fast, and you destabilize exports. Too slow, and inflation eats credibility. So any serious adjustment to the dinar, if and when it happens, would have to balance political stability, fiscal needs, and external credibility all at once. That's not speculation. That's central banking reality. And this is where many narratives fall apart. They assume a single objective: raise the value. In reality, the objective is control. Control over inflation. Control over capital flows. Control over confidence. If you understand that, the story stops being emotional and starts being analytical. Now let's talk about risk, because this is where responsible commentary earns trust. Any period of monetary transition introduces volatility, not necessarily in the headline exchange rate, but in access, pricing spreads, and policy signaling. If Iraq were to move toward greater currency flexibility, the early phase wouldn't reward impatience. It would reward clarity. Mispricing would occur. Rumors would accelerate. Bad actors would exploit confusion. We've seen this playbook before in Eastern Europe, in parts of Asia, in Latin America. The pattern is always the same. The loudest voices appear first. The clearest signals appear last. That's why patience isn't just emotional discipline, it's analytical discipline. Another layer most people miss is timing relative to global cycles. We are not in an era of loose global money anymore. Central banks worldwide have become more conservative, not less. That makes large-scale currency realignments harder, not easier. So if Iraq wants to move forward, it has to do so under tighter scrutiny, not looser conditions. That doesn't block progress, but it shapes its pace. Now ask yourself this: if you were an Iraqi policymaker, would you announce a dramatic revaluation and risk destabilizing expectations? Or would you quietly adjust frameworks, reduce distortions, and let confidence rebuild over time? History gives us a pretty clear answer. Which brings us to the real forward-looking question, not when, but how. How would a genuine shift first become visible? Not through leaks, not through bank whispers, but through boring signals, changes in settlement rules, adjustments to currency auction mechanisms, new regulations on cross-border payments, improved transparency from the central bank. Those are the breadcrumbs that matter. Everything else is noise until proven otherwise. And yet this is important. The fact that these conversations persist tells us something real. It tells us that Iraq's currency is no longer ignored. It tells us that people are watching for normalization. It tells us that expectations exist, even if they're poorly framed. That alone is a shift from where things were a decade ago. But there's still one more dimension we need to address, the one almost nobody talks about. What happens psychologically and economically to holders when expectations stretch too far ahead of reality? And how does that affect market behavior when change finally does come? That's where the real risk and opportunity lives. And that's exactly what we break down next. There's a psychological component to this story that rarely gets addressed, but it's critical if you want to understand why the dinar narrative behaves the way it does. Expectation risk. In markets, expectation risk can be more destabilizing than price risk. When people anchor themselves to a specific outcome, especially one tied to time, value, or life-changing impact, they stop processing new information objectively. Everything becomes confirmation. Contradictions get ignored. Delays get reinterpreted as secrecy. That's not unique to the dinar. We've seen it in tech bubbles, commodity supercycles, crypto narratives, and even sovereign debt crises. The longer an expectation persists, the harder it becomes to recalibrate. This matters because if Iraq does move forward incrementally, procedurally, without spectacle, many people may not recognize it for what it is. They'll be waiting for fireworks that never come. And ironically, that's often how real monetary change looks. Underwhelming at first. Now think about market behavior. When expectations outrun policy, volatility doesn't show up immediately in prices, it shows up in decisions. People overextend, they delay diversification, they ignore opportunity cost. That's the hidden cost of narratives that promise transformation without explaining the process. A serious observer does the opposite. They ask, what conditions would have to exist for this to work? What signals would invalidate this thesis? What would partial success even look like? That mindset doesn't kill optimism, it disciplines it. Now let's bring this back to Iraq itself. The country is still navigating political fragmentation, infrastructure gaps, and external dependencies. Any currency reform has to operate within those constraints, which means even a successful path forward wouldn't look like a straight line. There would be pauses, reversals, policy contradictions. That's not failure, that's governance under pressure. This is where most commentary loses credibility because it treats complexity as weakness instead of reality. But there's another angle worth considering. Even without dramatic revaluation, incremental improvements in monetary credibility can still matter, especially domestically. Lower inflation volatility, more predictable imports, reduced reliance on parallel markets. Those are real economic benefits, even if they don't make headlines. And if those improvements accumulate, external perception shifts slowly, then suddenly. That's how confidence actually returns, not through announcements, but through consistency. Now, let's address preparation because this word gets misunderstood constantly. Preparation is not positioning all in. It's not betting on one outcome. It's not waiting frozen for a single event. Real preparation is optionality. Understanding liquidity access, knowing regulatory constraints, being aware of transaction mechanics, having flexibility if conditions change. That applies whether you're watching a currency, a commodity, or a macro trend. And it's the difference between participation and exposure. Here's where it gets subtle. When narratives promise certainty, they remove optionality. When analysis emphasizes uncertainty, it preserves it. That's why serious institutions speak carefully. They don't need excitement, they need resilience. So when you hear talk of confirmation, the responsible response isn't belief or rejection, it's context. Who said it? In what capacity? With what incentive? And against what institutional reality? Those questions don't kill the story, they reveal its shape. And right now, the shape of this story suggests something important but unspectacular. Iraq is still on a long road toward normalization, and people are impatient for signs that the journey is accelerating. Some signs are real, some are exaggerated, and some are simply misunderstood. The challenge and the opportunity is knowing the difference. So if you're watching this space, the most valuable thing you can do isn't to wait for an announcement. It's to refine your lens. Focus on mechanisms, not milestones. Signals, not slogans. Process, not payoff. Because when genuine shifts happen in global finance, they rarely announce themselves loudly. They reveal themselves quietly through policy alignment, institutional behavior, and sustained consistency. And when that moment comes, those who understand the system will recognize it immediately. Everyone else will still be waiting for the headline. That's the real divide. And that's why this story, despite all the noise, remains worth watching. Not for what it promises, but for what it teaches about how money, power, and patience actually work.